Welcome to the Jones Zone, a podcast by Darryl and JJ Jones.
Hello, everybody. Welcome to another episode of the Jones Zone. I appreciate everybody watching. Today, we're going to talk about 1031 tax-deferred exchanges. We've got an expert in Mike Arbach joining us. Welcome, Mike. I appreciate you joining me and doing this favor for us and educating the public about 1031 exchanges. How long have you been working with 1031 exchanges?
Yeah, so I've been with the company a little bit over 6 months. I'm one of the partners here. Our whole thing is we're trying to mass educate people about 1031 exchanges and why it's a great tool to use to generate wealth in real estate.
Well, let's go ahead and dig right in. So tell us, what is a 1031 tax-deferred exchange? In fact, I've been told you got to add that deferred word in there opposed to 1031 tax exchange. It's 1031 tax deferred exchange. But go ahead. What is a 1031?
Definitely. So simply put, Darryl, a 1031 exchange is a swap of one investment property for another property without paying a dime in tax. So, I'm not sure if you're aware, but 1031 exchanges have been around the country, for 100 years. They actually started in 1921, and it's been a tool that people have been using for a long time.
Awesome. And tell us more. It's when an owner of an investment property sells that to buy another one, let's say they bought it for $500 and they're selling it for $1 million. So typically, if they didn't do a 1031 tax deferred exchange on that scenario, basic math scenario, we won't take the closing costs into consideration yet, but that's a $500,000 gain that they would normally pay a capital gains tax. So what this does, it defers that capital gains tax for down the road or potentially even never, right?
Correct. Yeah. The whole mechanism of the 1031 is to defer, your real estate gains tax free. And that's what the real true power is. And I'll kind of show you, got a little hat. It's all about compounding tax free, if you can see that.
All right.
It's being able to identify an investor having their ability to meet their investment objectives without losing equity to taxation, just like your example. So in your example, if you had $500,000 on a gain that you had to pay taxes on, essentially you'd have less money to go out and swap into another investment property, right? But if you defer the tax, all of a sudden you're able to buy more property, larger properties, more productive properties. That way you can generate ultimately more cash flow.
What specific types of properties would qualify for a 1031 exchange?
U.S. real estate will qualify as long as it's an investment property. So, just to give you an example, you can exchange raw land into a rental home, you can an apartment complex into a shopping center, or like what we're seeing now is you can diversify from an office building into a bunch of different rental homes. So, there are more than 16 different types of real estate that qualify for 1031 exchanges. And here's the best part, Darryl, is, you are eligible to do a 1031 inside any city or any town in the US as long as it's held for business or investment purposes. And so what we like to say is you have nearly infinite exchange options.
Meaning that you could, for example, sell a property in California and buy something in Maine or in Ohio or wherever.
Correct. Yeah. We're seeing a lot of people will go from California and they'll get more yield in the Southeast, right? Or we're starting to see people go from the Southeast and look at some interesting opportunities in office in, the West Coast. So it's really comes down to how, the 1031 can play into what your investment goals and your objectives are. And the great thing is, a lot of people shift their investments and their criteria and their strategies around once, the market changes, like we've seen in the last, 18 months.
So how to identify a potential replacement property? Like you said, you can sell raw land and buy houses, sell an apartment building and buy an office building.
Definitely. I mean, look, you got to put in the work to find an asset you want to buy, and then you fill out an ID form by day 45. And there's an old saying that we say over here at 1031 Specialist, Darryl, is proper planning prevents poor performance. So the point is to kind of plan ahead. And, one idea that we share with people to get started is, have your broker just shortlist 10 properties for you, even before or during when you put your property on the market. That way you're not up against the timing risk that comes with the 1031 exchange. So there are different things that we advise and definitely different ways which you can, be proactive and plan. And I think that's, just being proactive and getting ahead of it versus just, waiting until the clock ticks down to kind of start your search.
On that note, tell us about the time constraints. What are the rules on that?
Definitely. The clock doesn't start until you close on the sale of the property that you're selling. Okay. So, you're going, then you've got 45 days to identify property or properties to meet the ID requirement. And then you've got 180 days to close on the transaction. So, again, one of the things that we say, Darryl, is, when you want to list your property, start looking for replacement properties. That way, you don't know if your property is going to sell in 2 weeks or if it's going to take 2 months or, as we've seen recently, going to take 6 months to sell. All of a sudden, you're adding a lot more time just before those 45 days that are required by the IRS to submit an ID form to start your search.
And explain that ID form. And I think the easy way to explain that, and correct me if I'm wrong, is just basically saying, hey, here are 4 potential properties. And can you have more than one?
Great question. So an ID form is pretty simple. It's just a simple form that a client fills out. 95% of our clients typically fill out 3 properties or less being identified. There's a couple other rules that I'll get into in a second. But let's just say, for instance, you're on ID day 10 and you find these properties and you're like, actually, come day 30, I want to identify, 3 different properties. You can just refill and switch out the ID form. And that's pretty consistent across the board. If you identify more than 3 properties, there's a couple other nuances that I'll get into, which is, first, the combined fair market value of more than 3 properties does not exceed 200% of the value of the property that you're selling. That's known as the 200% rule. And then also, if you do identify 3 or more properties and the value exceeds 200% of the property that you're selling, you have to acquire at least 95% of the fair market value of the properties identified in this letter, known as the 95% rule. I think most people identify 3 properties or less. That's typically, but there are rules that I just mentioned that, we can help walk through folks that if they are going to acquire more than 3 properties, we make sure that they're, conform to the, ID period reporting.
And just to put that in for an example purposes, you sell that house in California for $1.5 million. You can go to Michigan and buy 3 properties for $500,000. Actually, in that scenario, you could sell for even $1 million and buy up to $2 million worth of properties. Fair to say? Correct.
Yeah. Yep. Okay. You got it. Exactly.
What happens if you don't identify something in 45 days?
Great question. So let's say for whatever reason, you don't identify something and during your first 45 days. Simply put, you get the money and then you're taxed on the amount. The way most qualified intermediaries do things is, if you don't ID in the first 45 days, you're going to get your money back day 46. Let's say you do ID 3 properties, and day 135, you're like, hey, Mike, we're actually not going to go through with this. You're going to get your money back day 181. So it's important to note that you're definitely going to get your money back, depending on if you ID or don't ID is when the timing comes into play on when you get your money. But also, you're just going to be taxed like any other, transaction that hasn't utilized a 1031.
So it's pretty strict. You need to identify the property within 45 days. No messing around.
Correct. Yeah. The deadlines are firm regardless if it's a, Saturday, Sunday, or holiday. And that's where people get into some hot water because they forget, like, oh, hey, it's, Columbus Day, or hey, I'm closing on a Sunday. Like maybe it rolls to a Monday. No, I mean, these deadlines are firm, regardless of, those deadlines.
And just to clarify for the audience, you have to just identify 3 properties. You don't need to close that escrow you have 180 days?
Correct. Yeah. So, what we like to say is, like, you have to identify 3 real contenders. You can't just put a couple different addresses that, you don't have any intention of actually closing on. Most people close on 1 property and they have a backup in a third, right? So it's really important to make sure that, they're real contenders here. And as part of reporting to the IRS doesn't want you to just make up addresses just for the sake of making it up.
Sure. That makes perfect sense. Now, it's funny. You said it's taking longer sometimes. Where are you at? What state are you in?
I'm in Denver. We've got a couple offices in California, though. Some of my partners are out there. So
the reason I brought that up is I want to touch on another type of exchange, which is the reverse exchange, because I've done a few 1031 exchanges, both reverse and let's call it regular. I guess, is that what you call it? Regular exchange and a reverse exchange?
Yeah, we call it like primary, or like a forward exchange, is when you sell first and then you buy, you identify and you buy later. A reverse is when you buy your property first and then you sell one of your properties within the 180 days. We tend to see a lot of well-capitalized folks do that just because, you have to go out and typically buy that. And also, a lot of family offices do the reverse exchange because they're very well capitalized and pretty savvy.
We're in a kind of a tight market. It's easier said than done right now with such low inventory. So I am guessing that in a market like this, you potentially want to consider a reverse exchange more than a forward exchange, as you said, because then you obviously don't have to worry about naming the property, identifying the property. But you're right. Of course, you have to be able to qualify. On that note, I did a 1031 exchange a few years ago. And one thing that surprised me was the loan amount. That surprised the heck out of me. I didn't realize that the loan amount has to be the same between two properties, or how does that part work?
Yeah, definitely. So you have to, for full tax deferral, you have to have the same proceeds transfer from the property that you're selling to the property that you're buying, right? So, if you're selling a property for $4 million, and you want to make the complete deferred exchange, and let's say you're at 50% loan to value, you have to take out a loan of $2 million and then put $2 million cash into your replacement property to get the full tax deferral. So that's kind of how that works.
Can that vary? Let's say if you don't hit that equation, you still get some benefit from doing it?
Oh, definitely. Yeah. I mean, we have people who do, partial exchanges. I mean, other people will add more cash, add more value to the replacement property so they can satisfy, the 1031 exchange. There's a lot of different creative scenarios that, people have that we're happy to kind of explore for them because, Darryl, as you know, every person and every property is so different and specific. So part of our job is just educating people and making sure that they have options so they're best informed to kind of go forward and have a successful outcome.
And I suppose the pros and cons of doing, let's say, the regular exchange, I guess I'll call it, is, well, you have to identify that property and find that property. If you don't, you're going to be out of luck. If you do a reverse exchange, you buy the second property first and then go and sell the one that you're 1031 exchanging. Well, you just have to sell it. If you don't sell it, then okay, well, I guess you're just bought yourself a new rental property and you can go on and try to do another 1031 exchange on that property if it doesn't sell. Does that make sense?
Yeah. I mean, that does make sense. You'd basically be saying hey, you're not going to do the reverse. I'm just going to buy a property with cash regardless. And then I'll potentially just try and do a regular forward exchange and put my property on the market and then identify later. So yeah, I think the word that I'm looking for is be creative, and there's definitely some safeguards in place. But most people that do a reverse, I would say that they plan ahead and they're pretty savvy. So they either know hey, if I'm going to put my property in the market, I'm going to price it to sell versus, what we're seeing right now is a lot of sellers putting stuff on the market and they're like, hey, Darryl, if you don't pay me my number, that's fine with me. I've made a lot of money over the past couple of years. So it's a different type of seller, in my opinion.
What about REITs? That's a real estate investment trust. For those that don't know, heck, I barely know about them. But what about REITs? Can you sell a house or whatever and then buy into a real estate investment trust?
Yeah. So no. Well, first, no. If you're an LP in a private real estate fund or a shareholder in a publicly traded REIT, you won't qualify for a 1031 exchange. There is something called a 721 UPREIT, which is private, which some people can, it's basically they contribute their houses to a private real estate fund for shares in that fund. However, once they're in that fund, they lose their 1031 ability to defer taxes when they come out of the fund. So it's a final destination kind of for your deferred tax journey. And a lot of folks, after they come out of the fund, will be taxed on their gain.
And then that leads me to another question. How many 1031s can you do with let's say, starting off with the same property and moving on? And do you have to wait a certain period of time? Every 2 years, you can do an infinite number of exchanges as long as it's 2 years? Or how does that work?
Yeah. So, from the timing generally, every 2 years, there's no hard and fast safe rule. But the great thing about doing a 1031 exchange, Darryl, is that there's no limit to the amount of times you can 1031. And frankly speaking, that's why the 1031 grandmasters just keep exchanging. So, while we're alive, a 1031 allows us to buy more property with a higher basis, benefit from more bonus depreciation, generate more cash flow. And then, when we go on to pass, our kids will inherit our portfolio, they'll get a step up in basis and they won't pay a dime on the lifetime appreciation that, we made happen. And so they will avoid taxes altogether, which is really interesting. And a lot of people think like, hey, eventually I have to swap. And even if I'm older, I have to swap out and, pay taxes. Well, no, that's really not the case. You could, once your kids inherit it, they won't pay a dime in tax.
So you can do a tax deferred exchange on a vacation home or a second home or no? How's that work?
What we like to say with like a second home or vacation home, like that generally implies personal use in our opinion. And if you use a property for more than 14 days out of the year, it's no longer an investment property. It's a personal use property. And personal use properties don't really qualify for 1031 exchanges.
All right. That's a real important note. So what's the role of a qualified intermediary in a 1031 exchange and why is that necessary? And tell me this, is that the same as an accommodator? That's the same thing.
Yeah, the qualified intermediary and an accommodator are interchangeable. It's interesting that West Coast typically likes to say accommodator and a lot of other folks like to say qualified intermediary. But to answer your question, Darryl, a qualified intermediary like 1031 specialist is an independent third party required by the IRS to facilitate 1031 exchanges. And a QI does three primary things. Well, first, they consult with the client before and during an exchange. And second, they prepare exchange docs to ensure that transaction conforms to Section 1031 of the tax code. And finally, they protect and direct a client's funds during the exchange period. And
I think it's really important to note, too, that when one's selling their house, their rental, and doing this, it's extremely important. You have to have a QI or accommodator. You can't touch that money whatsoever. It can't hit your account for an hour and then you deposit it somewhere else, or else, boom, it prevents you from doing a 1031 exchange, right? Can you talk a little bit about that?
Yeah, definitely. Like that is one of the most important things, Darryl. An investor cannot take constructive receipt of their funds even for a second. So the second the funds hit their bank account, the exchange will fail and they're no longer eligible, for the 1031 tax benefit. So what we always tell people is, engage your QI, right as you're planning to, put your property on the market so we can kind of stay in touch and monitor when you go under contract and go under escrow. Because if you close and take constructive receipt of the funds, you're not going to be able to utilize, a 1031 tax deferred exchange.
So to get specific, you close escrow on their house and then the funds would be wired directly to you or to an accommodator or QI.
Yeah, actually, like we don't hold the funds at all. So this is the way, our process works. So we come in, the funds get directed to our partner bank in a segregated trust account in the client's name where the funds will sit for the duration of the exchange. When it's time to close on the replacement property, Darryl, we'll instruct the partner bank to wire those funds to the seller of the replacement property, thus completing the 1031 exchange transaction. We're not the bank. We don't hold the funds. What we like to say is we're the facilitator. So a lot of people are like, are you guys holding the funds? We're like, no, we're just directing everything and making sure everything's compliant and making sure everything is safe and secure.
That makes a lot of sense. Can people 1031 exchange out a property held in title holding trust and acquire a replacement property?
Generally speaking, Darryl, any taxpaying entity can do a 1031 exchange. The IRS has a same taxpayer requirement for tax tracking. So if the same person or entity is exchanging, it's pretty easy. If not, we'll recommend bringing in our structuring attorney to ensure the right steps are taken to maintain eligibility.
Let's qualify entities. That would be an LLC, obviously a single person. Go ahead.
Yeah. A lot of people, will have partnerships with multiple partners, right? Typically we see a lot of LLCs with a lot of different members just because they all like to kind of be, in a deal together. And question that I get all the time is, can some members of the LLC do their own exchange or cash out at the time of the sale of the property? And the answer is yes. So the way that works is it's called the drop and swap. And that allows investors to drop out of their current ownership structure, break away kind of from their partners to buy a property on their own. And, just like I mentioned before, it's really important to get an attorney involved, particularly in a state like California, before you sign a purchase and sale agreement to make sure the structure is all intact. That way, if people want to go their separate ways, they're set up in a way where the IRS qualifies them to be able to do a 1031 exchange.
But they can do it. So let me and a partner, and we sell a place for $1 million. they can go buy something for 500. I go buy something for 500 and we've satisfied the exchange. I mean, that's a brief overview. With some
Exactly. But you'll have to have an attorney make some revisions to kind of the LLC agreement before you have a purchase and sale on the property that you're selling, which is really, really important to make sure that you guys will be able to go on and go your separate ways.
How about this? And not to get too much into the weeds and details. Obviously, at one point, it's probably best for someone to just go ahead and specifically talk to you in person or on the phone.
Totally.
But if, let's say, I won't do too many of these if questions, but if there's five, let's say there's five people in an LLC, five buddies from college form an LLC, they buy a rental, and it's gone up to whatever, doesn't matter, $1 million now. And one of them says, I'm kind of done with this. So I want to get out. The four can stay together and one can get out and maybe just not. How does that work? Or am I making sense at all?
Yeah, definitely. I'm not an attorney, but typically how attorneys would structure this is, they restructure the partnership, and essentially, like I mentioned before, the people would, buy out a member, which is totally doable. And their interest could be, used as 1031 to go on and buy something else. But again, it's all about structuring with a specific real estate attorney. And we have a ton that, we can recommend, but it's definitely doable.
Okay. That's probably the good and the best answer, because there's too many details that you're going to need to know, I'm guessing.
Totally.
Are there any tax implications or obligations during the 1031 exchange? If so, how does that affect any capital gains taxes?
Yeah, definitely. We're not CPAs, so we can't really give specific tax advice, but I'll just say, that any investor that sells a property is subject to as many as 4 different types of tax. So first, you're going to have your federal capital gains tax. That's going to be anywhere from, call it 15 to 20%. Then you're going to have the state tax, varies from 0% in Florida to around 13.3% in California, as I'm sure you're aware of, Darryl.
Yeah.
And then you've got, bummer. Then you've got the net investment income tax, which is around, hovering around 4%. And finally, you have the depreciation recapture tax, which is 25% of what you depreciated. And again, these can all be deferred in a 1031 exchange.
Speaking of depreciation, that's one thing that I was also, I just hadn't realized it, frankly, was I was thinking that one could start over the entire depreciation schedule, but you don't.
No.
Okay.
No.
Okay.
So
provide an example of a situation where the 1031 exchange can be particularly advantageous for a real estate investor.
Yeah, definitely. So I think over the past, call it 3 years in the COVID era, a lot of folks have, not returned to work, and a lot of the office properties, as I'm sure you guys are aware of, have suffered. And we worked with a group. They had a nice Class A office building in one of the major metros, and they swapped into a great multifamily portfolio in the Southeast. And we're able to kind of replace and defer taxes and make sure that they got the full tax deferral. And why that's important is in 2024, there's a lot of different asset classes that have, been hot and have been cold, and a lot of different areas of the country where you can, basically buy and place some bets where, there may be more population growth like we've seen happen, or there may be better opportunities. So, it's really, a 1031 is really advantageous for investors, Darryl, just because they can swap in and out of different assets, in and out of different towns. They can go from one property to multiple properties, or go from one property, and spread it out across, a bunch of properties, right? So there's a lot of benefit there.
And is there a limit? So, I mean, if someone was blessed enough to, let's say, make 50 million on something, there's no limit.
There's no limit at all. I mean, we've done, 9-figure exchanges with very well capitalized people, and you'll be amazed that those guys have started earlier in their career with one property and then just kept swapping and trading up and trading up and trading up. And, just have had great luck utilizing the 1031 as a tool to kind of, defer taxes and compound their gains.
And you mentioned this earlier, so you may have already answered it, but I want to just confirm. One has to buy in the United States, though. They can't go and buy in Costa Rica or whatever.
Yeah, they have to be U.S. property all throughout the U.S. I mean, Puerto Rico, you can't do that in Puerto Rico. There are, some territories where you can 1031 in and out of in the Caribbean, but mainly any of the 50 states, are fair play. And, we see people, go from Hawaii to Indiana. We just helped a client, last week, do that. So people are always moving around, and, as long as it's held in the US, it's fair game.
So anything changed in the last few years? Laws that have changed?
From our standpoint, no. There's always things on the ballot threatening that the 1031 may be, on its way out. But, we believe nothing has changed. I mean, besides in 2017 with the Tax Cut and Jobs Act, which no longer allows personal property. Now it's real estate. We believe that 1031s are going to be around, as long as, we're around. So nothing material has changed lately.
Can you recommend any resources or professionals who can assist individuals in successfully navigating a 1031 exchange? I'm guessing, first of all, that's you.
Yeah, definitely. I mean, that is what we do. We focus on 1031 exchanges for clients all, throughout the 50 states. And that's what we do full time. But we've got a ton of great resources for you guys on our website. We've got, if you want to run a specific scenario, we've got the best 1031 exchange calculator out there. You can calculate your capital gains, understand your specific tax exposure, and run scenario analysis on different 1031 replacement properties. And we've got something, Darryl, called our ebook. It's our 1031 Bible. Literally, it's everything you need to know about 1031s. We've simplified it. We've packaged it really nicely together, and it's really 98% of anything that you need to know. And that's, of course, if you've got a specific exchange question or ready to do a 1031, you can email me at Mike at 1031specialist.com, or give us a call, 638-431-1031.
So that booklet or that site, is that something you want to have people go to now and give that out, or just have them contact?
It's on our website. It's under our About Us. They can download it. They can fill out a little form. They can download it. They'll have it immediately. Or if they feel more comfortable just giving us a call or emailing, we could send it right over to you.
I think we're near the end. Is there anything that I've asked that I should have that you would think would be important?
Just to tell most folks, 95% of what we do is educate. And what we're really trying to do here, Darryl, is, we believe that all real estate transactions, in terms of investment real estate transactions, 10 to 15% maybe utilize the 1031 exchange. And our whole goal is, we want to make people aware that they're able to use this as an effective tool to generate more income and more wealth for them. And, we'd love to talk to anyone and be a resource for people that has those questions. And no question is a dumb question, as we like to say. And, we're happy to kind of, hold someone's hand and walk them through and get them educated.
Any other things that people should be looking for or be aware of as a negative aspect?
Not really. I think, I always just say hey, proper planning, right? We talked about planning. It's super important in terms of a 1031 to get a qualified intermediary involved right away. And just remember the deadlines, making sure that, you're aware of their firm, regardless if they, fall on a Saturday, Sunday, or holiday. And again, we're here to kind of help remind you of those deadlines. So, you have a good team with you, but I would say those things, would help make sure that you have a successful outcome in your transaction.
Well, this has just been fantastic. I've learned a lot. Hopefully our audience has learned a lot. Let's go ahead and end this with one more thing. Just go ahead and repeat how to get a hold of you in case anybody wants to talk to Mike.
My email, I'm Mike at 1031specialist.com. Our phone number is 631-438-1031. We've got a Twitter account, Mr. 1031. If you want to follow us, we post a lot of cool active stuff. We're on Instagram, we're on LinkedIn, we're on Facebook. And if you want to get in touch with us in any of those ways, we're happy to speak with you and answer your questions.
That's great. Mike Arbach, I'm so grateful for you joining us today and enlightening the public to what a 1031 exchange is, and just so grateful. So thank you.
Pleasure being on the Jones Zone.
All right. Well, hey, signing off, please subscribe to our YouTube channel or our podcast channel on Spotify or Apple. And again, thanks for listening, and stay tuned for our next show coming up very soon. So thanks again, Mike. Have a good one.
Darryl.
See ya.